There are more than 5,000 indicators available on TradingView. Most traders struggle to find the right indicators that work for them. I know I did. Indicators can either overcomplicate your trading or lead to cleaner and faster execution. Here are the best indicators I've used to transform my trading over the past 4 years. I'm unbiased trading, let's get into this. First is the volume weighted average price, which is also known as VWAP. This is a classic indicator that has been on my charts pretty much since the first year of trading, and I will pretty much atone that to Humble Trader as she kind of introduced me into VWAP. I use it both in a systematic way by looking at how VWAP has affected the price in the past, and in a discretionary way by using it to help me make trading decisions. VWAP is a must-have indicator for most traders, and I will say as well, in small caps, it is a great trade management tool. You can really find a lot of good data around, if it clears VWAP past like 1 p.m., for example, it's going to have a higher closed screen percentage, which means you can actually get out trades earlier by using this indicator, and that's what I do a lot of the time as well. So I would say it is a great one you should have in your charts. Next is Fibonacci retracements. This indicator has been great for helping me create precise levels for shorting and pullback trades. It's a quick and systematic way to enter a trade based on the Fibonacci extension moves. Now, I will also give credit to LaserWolf here. I pretty much never used Fibs before I met LaserWolf and started working with him. He is an absolute beast of a trader, and he uses Fibonacci's a lot as well in his room and just in his trading overall. Now, I won't give away any of his kind of secret sauce, but I would say a lot of it, even JTrader as well, actually mentions Fibonacci, so I guess I got them from both of those. But they're very good at becoming a systematic way to enter in on these kind of extension moves. If you didn't use Fibonacci's, I would say it's quite difficult to find a very systematic approach to what levels you're going to short. You can try and quantify daily resistance, as I've kind of done with previous clients before, but there's always some hindrance with trying to quantify those kind of ways, whereas with Fibonacci you can actually add edge to a system, and most of the times I found it. And more I've seen more and more traders come to me looking for Fibonacci kind of backtesting code, and I would say it's most of the time pulled out very good results. So I would say this is something you could definitely look into. Probably watch a couple of LaserWolf or JTrader's videos to kind of catch up on like how to use them, and then try and experiment with yourself as well. Next is exponential moving averages, another classic indicator that is used by many traders already. EMAs are great for providing a systematic way to enter or exit trades. In small caps, they have been a great exit trigger for me. The classic is like the 1 minute 200. I think that was kind of popularized by JTrader as well. And a couple others like 5 minute 200, 1 minute 50 EMA, those kind of ones that can be very useful for exits. Now, I will say I've never really found much success using them as entry criteria. Most of the time, if you use the fast EMA like a 9 or a 12, it's just too noisy most of the time for these extension moves. Sometimes they can be great for parabolics. So if you have something that's going up, 50% in 2 candles, then and break of a 9 EMA, that can be very useful and sometimes quite profitable. Depends the kind of filters you put on it. But yeah, overall EMAs for me have been more of an exit tool, and they have been great for helping me hold longer. Now, I will say, most of the time, end of day exits will be any of these EMA exits. However, for certain types of traders that are finding it hard to hold until end of day, this can be a great kind of middle point where you're getting out a bit earlier than you really should be, but you're still holding way longer if you didn't have this EMA that you're like targeting, for example. So definitely give EMAs a try. I'm sure most people that follow me probably already use EMAs, but if you aren't, definitely use them. Next is volume profile. This indicator displays the total volume traded at every price over the session, and has been extremely useful for me in making levels for my futures algorithms. Now, I've never really found much use to volume profile in small caps. I think I know maybe 1 or 2 traders that do use it, and they're just incredible at using it in that way. For me personally, I've never found much success with it. So I mainly use this actually in futures, so for ES and Q, and for my kind of algorithms, volume profile has been a great way to determine some kind of levels. This can be sometimes just using VPOC, and sometimes it's just using like zones of very high volume and where it drops off significantly after that zone, and that's why I put the 2 levels, for example. So you definitely look into volume profile. I think it's a really big tool for ES and NQ because a lot of ES and NQ is bigger traders most of the time, and it's more institutions, you've got more players at hand compared to small caps where you're just kind of getting warrant holders, underwriters, and sometimes like pump and dumps, which isn't necessarily as many big players to when you're trading ES and NQ. Now, obviously, this is just my perspective. I'm not 100% sure on that. I don't know anyone inside this kind of pump and dump schemes for small caps. That's just at least my impression and what I've kind of heard as well from all these other great traders. Next is linear regression channels. This is a favorite of mine. It's really important to keep these channels static so they don't change over time. You can do this by setting them over a certain number of bars. When I originally did a Twitter post or Twitter thread around using them, I got a lot of comments around that. I am aware that you can make them not static and static. I think you can use them both. I personally like them in both ways, but when you're trying to be more systematic and algorithmic, then yeah, you definitely need them static and you can't have them adjusting to the highest price all the time. Now, what actually are linear regressions? Linear regressions are simply a linear relationship between a dependent variable and one or more independent variables. Linear regression channels are similar how they plot a straight line that's the best fit between the prices, between the starting and end points, so overall it's pretty basic calculation. What makes the indicator a channel is that it includes a above and below line. These are formed by applying two standard deviations, added and subtracted. You can change how many, which create from the linear regression line. This creates an expected top and bottom for the price section. How do I personally use them? Now, I personally mainly use them in a couple main use cases, which is trend identification, mean reversion pivot points, breakouts, and breakdowns. Another huge case I use them for is the slope. Unlike Bollinger Bands, you're able to measure the steepness of a linear regression channel, allowing for the detection of extremely strong trends or fast moves, and it's really a game changer for some of my algos that I've implemented on. Now, I will say, I heard from someone how they calculated slope on Bollinger Bands. I have never even thought of that method. So I think it is possible on other indicators as well. This is just, what I found useful and what I found easiest to do. But linear regressions are really good because a lot of my high frequency kind of algos for futures are doing mean reversions most of the time. I'm kind of going by the philosophy of Ernest Chan, which you're saying you want to take a lot of trades because then if you've got positive expectancy, you are more likely to be at the mean of that positive expectancy because you're taking so many trades. Now, I am nothing of the measure such as a market maker or anything that's taking hundreds of trades a second. I am more taking a trade maybe that is lasting 5 or 30 seconds to maybe a minute. So they still are quite fast, but they're nothing that requires insanely good servers or anything like that. And normally on a day, for at least the highest frequency one I have, maybe we'll take 40 trades. So it's not taking them every single second. It's not like buying the bid and ask to try and profit from the middle. It is simply just more of a high frequency one compared to most people's. If I find the correct terminology of what you would call that kind of range of an algo, then I'll find it and let you know. But at least at the moment, I haven't found the correct terminology. Next is gap stats. Now, this is one I personally built for TradingView to show stocks stats of previous gaps before. This is just built on TradingView, and you can see these up and down kind of markers, and it shows where they've had a gap. And was it a green gap, so did it close green, or was it red? And you can see that marked by green and red. This helps determine trends to see if particular trades fade more often and potentially have more dilution. Now, I will refer to the short bear here. I think he knows best around really gap stats. How I've kind of used them is just being using his interpretation of them and then kind of adding some of my own things. A mistake I see quite common, and I want to clear it up on this video, is a lot of people only use gap stats as their stats. This is fundamentally very flawed. You're basically using a 10 sample statistic, which is not statistically significant at all. So if you try and use that as your only statistics to base your trade on, based just on these gap stats, it may work for a while, but there isn't actually any long-term edge in that, and the reason I know that is because I backtested them. If you were to trade every single ticker the same using the gap stats, they really wouldn't be very profitable, and you'd miss a lot of good trades. That isn't to say, though, they aren't great tools to add to your trading. I already know my basic edge in small caps. Most people already know it. It's a high gap percentage, and you're going to have a higher close red. And there's a couple other variables in there as well that kind of increases that and lowers the drawdowns. However, with gap stats, what the great thing is you can see similarities based on this particular ticker. So if I know the median over this particular kind of bucket of tickers is maybe 70% close red, but on this particular ticker within that bucket, so let's say 300 trades is the bucket, and then this particular ticker maybe has 7 gap stats examples, I can see it has closed red 7 out of 7 times, and it has only ever popped 4% from open, for example, and the median for that 200 bucket is maybe 10%, then I can use that to maybe lower my entry percentage based on the fact that this is a very strong trend, that it only pops a very small amount in the morning. Obviously, then you have some other stuff come into it like news, so you need to make sure it's not like FDA news or some kind of outlier news that has made the reason for the pop, because that would definitely skew your kind of results. However, that's kind of how I use it. So it's more of a confirmation, more of an added kind of cherry on top that I'm looking for. Now, totally nothing wrong if you do just purely use gap stats, just in my opinion, and at least statistically it doesn't make sense, but I know some traders are able to pull it off and they do amazing. So as with everything in trading, it always comes down to the trader itself, and there are not too many truths where it only applies. It just, at least for me and how I trade systematically, I wouldn't like to only trade just off gap stats, as it's not very statistically significant. Thank you for watching, and if you enjoyed, please like and share with anyone else who might be interested.